Mortgage. What is a mortgage? A mortgage is a debt instrument secured by the collateral of specified real estate property that the borrower is obliged to pay back with a predetermined set of payments. Mortgages are used by individuals and businesses to make large real estate purchases without paying the entire value of the purchase up front, over a period of many years. The borrower repays the loan, plus interest, until she eventually owns the property free and clear. Mortgages are also known as liens against property, or claims on property. If the borrower stops paying the mortgage, the bank can foreclose. Breaking down. Mortgage. In a residential mortgage, a home buyer pledges his or her house to the bank. The bank has a claim on the house should the home buyer default on paying the mortgage. In the case of a foreclosure, the bank may evict the home's tenants and sell the house, using the income from the sale to clear the mortgage debt. Mortgages come in many forms. With a fixed-rate mortgage, the borrower pays the same interest rate for the life of the loan. Her monthly principal and interest payment never change from the first mortgage payment to the last. Most fixed-rate mortgages have a 15 or 30-year term. If market interest rates rise, the borrower's payment does not change. If market interest rates drop significantly, the borrower may be able to secure that lower rate by refinancing the mortgage. A fixed-rate mortgage is also called a traditional mortgage, with an adjustable rate mortgage arm. The interest rate is fixed for an initial term, but then it fluctuates with market interest rates. The initial interest rate is often a below-market rate, which can make a mortgage seem more affordable than it really is. If interest rates increase later, the borrower may not be able to afford the higher monthly payments. Interest rates could also decrease, making an arm less expensive. In either case, the monthly payments are unpredictable after the initial term. Other less common types of mortgages, such as interest-only mortgages and payment option arms, are best used by sophisticated borrowers. Many homeowners got into financial trouble with these types of mortgages during the housing bubble years. Mortgage rate. Mortgage rates are the rate of interest charged on a mortgage. They are determined by the lender in most cases, and can be either fixed, stay the same for the term of the mortgage, or variable, fluctuate with a benchmark interest rate. Mortgage rates rise and fall with interest rates and can drastically affect the home buyer's market. Breaking down. Mortgage rate. A mortgage is the loan taken out to finance a home. It consists of multiple parts, including collateral, principal, interest, taxes, and insurance. The collateral on a mortgage is the house itself, and the principal is the initial amount for the loan. Taxes and insurance vary according to the location of the home and are usually an estimated figure until the time of purchase. The interest charged is known as the mortgage rate. Mortgage rate indicators. The biggest indicator for a high or low mortgage rate is the 10-year Treasury bond yield. If the bond yield rises, the mortgage rates rise as well. The inverse is the same. If the bond yield drops, the mortgage rate typically also drops. Even though most mortgages are calculated based on a 30-year time frame, after 10 years, many mortgages are either paid off or refinanced for a new rate. Therefore, the 10-year Treasury bond yield is a good standard to judge. The current state of the economy is also a good indicator for estimating a mortgage rate. If the economy is bad, investors turn to bonds to secure their money, and the bond yield drops. Mortgage rates become lower, and therefore more attractive to borrowers. If the economy is flourishing, investors seek other investment opportunities, and the bond yield rises. Increasing mortgage rates. Determining a mortgage rate. A lender assumes a level of risk when it issues a mortgage, for there is always the possibility a customer may default on his loan. There are a number of factors that go into determining the mortgage rate, and the higher the risk, the higher the rate. A high rate ensures the lender recoups the initial loan amount at a faster rate in case the borrower defaults, protecting the lender's financial investment. The borrower's credit score can often play a role in the rate charged on a mortgage and the size of mortgage loan he is able to obtain. A higher credit score indicates the borrower has a good financial history and is more likely to repay his debts. This allows the lender to lower the mortgage rate because the risk of default is lower. The rate charged ultimately determines the overall cost of the mortgage and the amount of the monthly payment. Therefore, borrowers should always seek the lowest rate possible. Fixed-rate mortgage. A fixed-rate mortgage is a mortgage that has a fixed interest rate for the entire term of the loan. The distinguishing factor of a fixed-rate mortgage is that the interest rate over every time period of the mortgage is known at the time the mortgage is originated. The benefit of a fixed-rate mortgage is that the homeowner will not have to contend with varying loan payment amounts that fluctuate with interest rate movements. Breaking down fixed-rate mortgage, there is typically a trade-off when it comes to choosing a mortgage between risk and reward, or between an adjustable-rate mortgage and a fixed-rate mortgage. Depending on market conditions, the shape of the yield curve, an adjustable-rate mortgage might have a large initial payment advantage over a fixed-rate mortgage. However, if such a scenario exists, there is a probability that the payments on the adjustable-rate mortgage will rise over time. Mortgage borrowers need to understand and measure risks when deciding between an adjustable-rate and fixed-rate mortgage. Read more. Mortgage definition, Investopedia, http://www.investopedia.com/terms/m/mortgage.asp#x4 feature. Follow us, Investopedia, on Facebook. Thank you for watching movie. Please subscribe and like to support us.